If you could take your seats, please. All right, welcome everyone, but if you would take your seats, we'll get started just a couple minutes here. All right, I see everyone taking their seats. All right. I just see a couple more. If you would take your seats, we'll get started. All right. Well, good morning, everyone. Great to see you. I'm Bob Harvey. I'm the president and CEO of the Greater Houston Partnership, and it's my pleasure to welcome you to the Houston Region Economic Outlook, the annual event that the partnership puts on to begin to shift our thinking from the year ending 2018 to the year up ahead, 2019. Before we get started, I would like to take a moment to recognize, remember, honor a great Houstonian, an honorary member of the board of the partnership, and that being President George Herbert Walker Bush. I know all of this by being here may have missed the funeral proceedings in Washington today. I'm hoping to see that on replay tonight. I don't need to tell you what a champion for Houston President Bush has been his entire life, his entire career. When he was president, what he did for Houston, bringing the leaders of the world here to Houston so many years ago, if you were here in the early 90s. A lifelong servant leader. And I'm pleased that I hear the word said of him repeatedly now, just a very decent man at a time when, role models of decency are something I think everyone's looking for. So could we perhaps join in a moment of silence to honor President George Herbert Walker Bush? Thank you very much. So now we'll continue with the event. Now earlier this morning we had a panel just across the hall geared to gain insight on the current and future Houston economy from a cross-industry panel of experts. So I'd like to thank once again the special guests who made that panel so effective. And many of you, about half of you I think were there across the hall. Our moderator was Shern Min Chow, the anchor of KHOU Channel 11. And I don't know if Shern Min was able to stay. She's been in College Station all week, came down for this, and now is running back to College Station for all the activities tomorrow, so I don't see Shern Min. Our panel consisted of Tony Canales, President and General Manager of Telemundo Houston. Why don't you all stand as I introduce you, because in case not all this group is there for the panel. Tony Canales with Telemundo, Mark Potter, Chief Technology Officer of HP Enterprise, Mark, Troy Villarreal, President of HCA Gulf Coast Division. Thank you, Troy. And Cindy Taylor. Did Cindy make it over? She may have had, excuse me? She's here. All right. She was here across the hall this morning. Cindy Taylor is President and CEO of Oil States International. Now, all four of these folks, Tony, Mark, Troy, and Cindy, serve on the board of the partnership. But as was well recognized before, and we'll say it one more time before the UT crowd takes over this event, we had an all-Aggie panel this morning. Jody, you weren't over there to defend. Not good, I know. A lot of mischief can occur when that happens. But we'll shift gears now and have a few UT folks, Jody. But I really appreciate the insights of the panel. Really appreciate you taking the time to give us a forecast on the Houston economy. Now, this luncheon will give us a chance to present the work of our award-winning research team at the partnership led by Patrick Jankowski, who's undoubtedly a leading authority on Houston's economy and a go-to resource for our members, the media, and our regional economic development allies. And I say all that partly to remind you as members of the partnership, and most of you are members of the partnership, that our research team exists to serve not just the partnership and the board, but all of you as members. And so please do reach out to that group when you need basic data and research on the Houston economy. Now, 2018, I would have to say, has been a banner year for Houston, is a good term for it. We saw job growth in almost every major sector of the Houston economy. We moved through our first full year of Hurricane Harvey recovery, and even though there's more work to be done, as I was mentioning this morning across the hall, we're clearly making headway. And I was going to say we've emerged from the latest oil downturn, but I don't think that quite captures the current situation in oil, as our employment, frankly, has not regained its place, going back to what energy-related employment was before the downturn, and of course with the volatility of the last few days, who knows. We did see the voters of Houston approve a $2.5 billion bond issue. That's critically important to moving Harris County forward as a more resilient region. $2.5 billion is a lot of money. I always tell people the Harris County Flood Control District on average spends $60 million a year, 60 million. So to have $2.5 billion to spend will do a lot to improve resilience, but we have a lot more we need to do beyond that. Sherman, you missed your moment. Everyone stood up and applauded, and it was Sherman Chow, everyone, KHOU Channel 11. Thank you, Sherman. So we'll continue to move forward on resilience efforts, and that'll be a big topic in Austin during the upcoming legislative session. So don't forget to kind of tell your representative, senator or state rep that there are a lot of needs in the Gulf Coast region that have not yet been met. Other milestones, one I'll point out, in August, LyondellBasell broke ground on a $2.4 billion project in Channelview, the largest of its kind in the world, and it's expected to come online in 2021. So I'll use that example. One of the areas where, again, we're seeing another rebound is in petrochemical construction. You know, we had a peak over several years, let's say 15, 16, 17, a little bit of a dip. Now we're seeing petrochem construction coming back. Another announcement of a completely different sort, Waste Management, one of the city's Fortune 500 firms, inked a new deal in Capitol Tower, new office building going up downtown, for about 285,000 feet. So an example of a company that is headquartered here, national non-energy headquarters, choosing to relocate and stay in Houston. And as much as we talk about attracting new companies to Houston, it's critically important that companies like Waste Management stay in Houston, so we're very pleased with that announcement. Another announcement of a different sort, Houston City Council signed off on $1.2 billion to upgrade the international terminal at George Bush Intercontinental Airport. So that project's getting underway, and it's all designed to keep Houston competitive as a gateway city, not just the U.S., North America, but across the Americas. And so we're very pleased to see that project moving forward. So we're going to turn our attention now away from 2018 and start talking about 2019. So shed some light on what we can expect. The partnership research team has produced a detailed forecast that discusses the trends and discontinuities driving Houston's economy next year. So after lunch, Patrick is going to come up here and let us know what we should expect in the year ahead. And I think as you leave this event, if I'm not mistaken, you'll get a hard copy of that report. So let me shift gears now and talk about, well, let me just acknowledge our sponsors first, which is important, then we'll move on to lunch. Let me recognize all of our sponsors, and then we'll applaud, if you don't mind, at the end. We have a great group of sponsors here today. Our gold sponsors today are Chevron Corporation and HCA Healthcare, specifically the Gulf Coast Division. Our silver sponsor is First Financial Bank. Our bronze sponsors are AT&T, CenterPoint Energy, Comcast Cable Communications, North Houston Economic Development Center at Lone Star College, and TD Industries. Our highlights publication underwriter is Wells Fargo. Our employment forecast underwriter is Transwestern. Our notepad underwriter is Mitsubishi Corporation. And our photography underwriter is BP Americas. And last, welcome entrance underwriter is Jacobs. Could we recognize all the sponsors that made this event possible? I would like to recognize, I saw one elected official who just came in. David Robinson, most of you know, is a city council member. Dave, where did you go? I saw you come in. Where are you? Oh, over there. All right, Dave, thank you for being here. And thanks you all for all you do for Houston. So with that, there were no members of the Consular Corps here this morning. Are there any members of the Consular Corps here now for the luncheon? Okay. Oh, yes. All right. Could members of the Consular Corps please stand and let us recognize and thank you. Thank you. Thank you. I normally introduce the Consular Corps by starting by saying how fortunate we are in Houston to have such a large and dedicated contingent. You know, we have the third largest Consular Corps of any city in the country, but I don't think there's another Consular Corps that works harder than the Houston Consular Corps to further trade, further business with other countries, and we just consider them, frankly, part of our team. So thank you for all you do. Now, this is a time of year when I particularly like to recognize the members of the board of the partnership who've worked hard all year. We have one more meeting. It's scheduled for December 19th, and people keep asking me, how did we schedule a board meeting as late as December 19th? Because I know this is a hard-working board that wouldn't think about quitting before the middle of the week before Christmas. So could the members of the board of the Greater Houston Partnership please stand and let us recognize you? Kenneth, I did not mean to leave the impression that only you were not invited to the head table, so I'll call you out. Thank you very much. So with that, I'm going to let you all enjoy your lunch. After lunch, Mark Watts will pick up the ceremony. Mark, as you probably know, is this year's chair of the partnership, president of the Friedkin Group, and has done a great job this year. So let me let you enjoy your lunch. Just in a few minutes, we'll resume the program. Thank you very much.
Well, good afternoon. Let's continue with our program. It's been a wonderful morning so far. I'm Mark Watts, president of the Friedkin Group, and as most of you know, I'm chair of this year's partnership. You know you've been spending a lot of time at the partnership when you really measure the start of the holiday season by Patrick Jankowski giving his economic forecast. But we're delighted to have him here today, and I'm delighted to introduce him. Patrick is a regional economist and senior vice president of research at the partnership. His observations on analysis and economic trends have appeared in hundreds of newspapers, magazines, radio, and television interviews. Patrick has worked for the Greater Houston Partnership and its predecessor, the Houston Chamber of Commerce, for more than 35 years, and leverages that experience as a keen observer of Houston's economy to guide our strategy. You know, high-quality research serves as the foundation of our efforts to make Houston stronger, and I encourage each of you to continue to view the partnership as a resource moving forward as we share available data with our members, including publications like the one you'll receive today, our Houston Employment Forecast, as well as Houston Highlights and our regular Economy at a Glance and our key economic indicator newsletters. I've known Patrick now for some time. He is a wonderful human being. He is a great resource for the partnership, a great resource for our community. So please join me in welcoming to the stage our foremost economist on the Houston economic scene, Mr. Patrick Jankowski.
Thank you very much, Mark. Thank you, everybody, for coming out to the Partnerships event again. I see lots of familiar faces. I see lots of people who are community leaders. It really is heartening to me and to the research team to see such support. Before I get started there, I do want to publicly thank Melissa, Roel, Nadia, Josh, Elizabeth, and Skip, part of the research team. And you may see me up here presenting data, but I've got a great group behind me that really supports me. They provide me whatever I ask for, and they put up my grumpy moods. So I just want to thank you guys very much for the help. Let's see if I can do this. This is a last-minute decision. Those sometimes are bad, but Wall Street Journal. I don't know if you saw it today. Headline, stocks tumble as trade fears jolt investors. We lost, 800 points yesterday? And the lead paragraph says, average fell nearly 800 points on bond yields as bond yields plummeted as investors doubt over U.S.-China trade truce, renewed anxieties about the pace of economic growth. And the media was playing up the fact that Trump has said that the Chinese are going to come to an agreement, but the Chinese haven't said that, and that moved the market 800 points. Well, the markets are closed today. This is hard copy. This is electronics. Wall Street Journal story in the electronic version today, China's Commerce Ministry in a statement Wednesday acknowledged for the first time that Beijing on Saturday agreed to a 90-day ceasefire to allow negotiations to take place. So it's good news, but it also I did that because I want to underscore a point, and that is, I started putting together the forecast back in October when oil prices were at $70 a barrel, and watched them fall as I was trying to put it together. And I even wondered a couple days ago whether I should revise the forecast. And I realized you can't base a forecast on the last data point. You can't even base a forecast on the last 2 data points. You have to look at the underlying trends in the economy. You have to look at the fundamentals of what supports growth or depresses growth. You have to look at the trends. And so I didn't change my forecast. This is what we saw when we started pulling the data and looking at it 3 or 4 weeks ago. And I still feel, even if you come up to me and say, well, with oil prices at $52, $53 a barrel, does anything change? No. It's still there. If there's some problems with trade disputes, no, we're still going to stay there. So that's just kind of a preface. So I want to go ahead and get started. Let's go ahead and get started on the presentation. You guys seen this? This has almost become iconic. You see this on coffee mugs. You see it on T-shirts. The British, they printed, what, 2.5 million of these back in 1939, 1940, as they were preparing for invasion of England, preparing for the Blitz. And this is something that was kind of to assure the population. This is probably the message we should have had for Houston. It's actually been the message we've had for Houston the last 2 to 3 years. Maybe the partnership should have invested some money in printing these posters and distributing them around town. Because you kind of think about it, we had some really bad economic news. The British were worried about bombardment from the air. We were being bombarded with data. The rig count fell 80%. Oil prices dropped 75%. Energy layoffs, close to 90,000 jobs in the energy sector were lost. Office vacancies doubled. Job growth was flat. Well, 2.5 years later, I think it's time to declare victory. The economy right now is in the best shape that it has been in since 2013 or 2014 for Houston. We have finally gotten through what our blitz of economic bad data, and things are looking good. Kind of evidence of that? Oil prices. Now, don't pay attention to that last data point. Look at where we were in 16 and look at where we were prior to the last data point. The last data point, I can explain to you. It's real easy. In May, President Trump said that we're going to impose sanctions on anybody who buys oil from Iran. Price of oil went up $10. In November, President Trump says, no, we're not going to put sanctions on anybody. Price of oil drops $20. That's not fundamentals, it's politics. The fundamentals are strong for oil prices to stay above the 50s. The rig count is back off the bottom from 404 to around just shy of 1,100, like Cindy Taylor was talking about. It's a little bit different oil industry now, but we're seeing growth there. Energy jobs, peak to trough. Each sector peaked and troughed at a different time. We started seeing some recovery on the blue-collar side while the white-collar side was still losing jobs. Add them all together, it's over 90,000 jobs, but we're starting to see growth in every sector. Office market. We're finally starting to see a little bit of improvement in the office market. This is important because what happens in the office market, it's a sign of growth in the white-collar sector of the economy. It's a sign of growth in professional services and so forth. Starting to see some pickup in the office market and payroll employment. Each one of those bars represents the total number of jobs which were created over the past 12 months. And you can see where we peaked in December 2014. You can see that downward trend. We were creating jobs in some sectors, but losing more of them in oil and gas or create the loss. You can see the losses in 15 and 16. You start to see it pick back up. Look at the far side. You can see pretty much a steady trend, and we see employment growth there. Well, if you're here in 2016, and I talked about what was the shape of the downturn and the recovery going to look like, and I use this metaphor. It wasn't going to be a hockey stick shape with a quick rebound. It wasn't going to be a slow, gradual rebound. The recovery is going to look more like a bathtub. A quick drop, a wide, flat bottom, and then a pretty sharp slope upward. The bathtub, guys, there's the bathtub for you right there. That was what the shape of the downturn and recovery looked like. Just like a bathtub, just like I said it would be in 2016. So, what's driving Houston's economy? For those of you who don't play golf, those are called drivers. They have a long shaft and a big head so they can move the bar farther down the field. The energy business is profitable again. 2 years ago, all those firms on the left-hand side, they were losing money. Only the firms on the right-hand side were making money. Is there anybody from Halliburton in here before I make the comment? Halliburton, I have Halliburton straddling the line because they made a penny a share. You kind of wonder where the CPAs were up late at night going, oh, what can we defer? What can we defer? But that was what the energy industry looked like 2 years ago, and that's today. Basically, they're all making a profit. Some of them are making huge profits. Some are making a little bit of profit. But the industry has become profitable again. It hasn't been that way for several years. The U.S. economy is doing real well. And you've heard me joke before, we hate to admit it, but Texas is part of the U.S. And when the U.S. does well, Texas does well. You get GDP growth. We've got 3.5% the last quarter. That's just great. 4.2% prior to that. Trade remains robust. In spite of the noise, in spite of the uncertainty out there, you can look at that light blue line, that's exports. The dark blue line is imports. And you can see where our exports are almost back to where they were prior to the downturn, and they're back to where we were with lower commodity prices. If you want to look at the absolute tonnage, our exports are up 25% in tonnage compared to this time last year. So trade is doing well for Houston. And companies continue to move to Houston. Those logos, they represent some of the 500 companies that announced they were going to open up something, they were going to expand something, they were going to relocate something here to Houston. Some of them are huge, like we talked about, LyondellBasell, $2.4 billion. Some of it's small, maybe it's just 100 people in an office. But these companies all decided that they were going to relocate or expand. But what's interesting about, you want to get some idea just how important the foreign direct investment is, the foreign expansion, take the foreign companies out and that's what you've got. Foreign direct investment is still very important to this region. That's one reason why we need to make sure that we don't annoy our allies. So is that what we should have now? Don't worry, be happy. I thought about putting a picture of Bobby McFerrin up there, but some people, hopefully everybody knew that was Winston Churchill earlier. I'm not sure people would know Bobby McFerrin. So yeah, we should be embracing this narrative, don't worry, be happy, but there are some things that have me concerned out there, some things that I'm going to be watching. Cindy Taylor, we talked about this, that blue line, that's total crude output. We dipped below 9 million barrels a day during the worst part of the downturn. We're up close to 11.4, 11.5 million barrels a day. Production is higher now in the U.S. than it's ever been before. Depending upon whose data you look at, we're either the first or second largest producer of crude in the world. That dark blue line, that's energy employment in Houston. And Cindy and Taylor and I with Gulf Oil States were talking about this. Those two lines will probably never intersect again. We may be in a period for a long period of time where we don't see significant growth in oil and gas employment because they've gotten so much more efficient with the technology. Exports, 17% of GDP now. Think about $1 in every $6 of GDP in this region is tied to exports. But we've got the threat of a trade war. Maybe not, but it sure does create a lot of uncertainty. And if you're in the business community, you can plan for risk, but you can't plan for uncertainty. Net migration, this is the number of people who move to the region every year. You've got about 200,000 people move in, about 160,000, 140,000 move out, gives you a net. But you need to look at the different colors in the bars. The red bars is called domestic migration. People have moved here from somewhere else in the U.S. The blue bar is international. Last year, domestic migration was actually negative. We had more people leave Houston than moved here on the domestic side, but it was made up for by the international. And if you look at that blue bar, that blue is pretty consistent over the last 10 years, last 7, 8 years. We can always count on 30 to 40,000 unless we decide to really clamp down on immigration. Now, I'm not saying we have a right to determine who comes into our country, but we need to be very careful that we don't shut the pipeline off altogether. And you guys know who that is, don't you? One of my biggest concerns right now is this self-fulfilling prophecy. I have sat in meetings with directors of research for other firms, and they've said they're telling their clients to plan on a recession in 2020 and to get their house in order. Now, if everybody believes that, it's going to happen. But we don't know that's going to happen. One of the biggest things that came out was all this news came out 2 weeks ago over Thanksgiving. The OECD, Organization for Economic Cooperation and Development, said growth is slowing. Growth is slowing. And it came with this gloom and doom like we're expecting to see significant slowdown in growth. You know, there's a difference between slowing down and going in reverse. I want to show you. This is what the table that accompanied the report looked like. Yeah, there's a lot of detail there, but this is what I want you to see. Global growth is slowing, according to them, from 3.7 to 3.5%. Yes, that's a slowdown, but that's not a recession. If you look at the G20, the most developed countries, slowing from 3.8 to 3.7. Even NABE, which Ellen and I are both members of NABE, they do a survey of the forecasters. I think, Ellen, you're part of this group, aren't you? One of the surveys? even NABE, even the organization that we're members of, says it's going to slow from 2.9 to 2.7%. So that's a slowdown. That's not a downturn. But that's probably one of our biggest concerns is this self-fulfilling prophecy. If everybody starts to believe it so much, it happens. Right now, I don't see that on the horizon, not in 2019. And I don't see it in 2028 either. So what's the outlook for Houston look like? What are we looking to see in 2019? Well, all the factors align in Houston's favor. The things which support us. Energy prices are off the bottom. They're back up into the 50s. U.S. expansion, we're going to continue to see U.S. economy expand. Global growth, yeah, it's slowed down a little bit, but we're still going to be growing at over 3%. Net migration, we're starting to see people move back. I can testify that by the out-of-state license plates I see on the freeway when I'm trying to get home in rush hour traffic. Construction is up, and consumer confidence is up. Let's look at some of these individually. Let's talk about oil. I went online, I tried to find all different sort of forecasts. Rather than any one forecast, this is what I've seen in the forecast. Oil between $58 and $70 a barrel, WTI. You can kind of think of it as a domestic price. The 71 to 83, that's Brent. Think of it kind of as an international price. And that's real important, that 58 to 70, because yes, this is a busy slide. Follow the black line. This is a survey the Federal Reserve Bank of Dallas puts together. They ask oil men and women, they ask the oil companies in their district, at what price do you need WTI to be to profitably drill a well? 47, 49, 50, $52, 53, 54, 55. So about where oil prices are right now, companies can still be profitable. Not real profitable, but they're not hemorrhaging the way they were hemorrhaging a couple years ago. And we are going to get some help. This is what Bloomberg put out, Putin and Russia, Saudi Arabia. They're meeting tomorrow to figure out what they need to do to curtail on production. I wouldn't be surprised if we see some support for oil prices come out as a result of this. But really, if we can keep oil prices in the mid-50s and up, we should be doing fine. I want to talk about manufacturing. You have to understand manufacturing in Houston is broken down two different ways. There's something called non-durables and durables. Durable, to think of it as a piece of equipment. Think of something that has a long lifetime, something which is durable. Non-durables, it's a component that goes into that, or it's something which is consumed, something which has a short lifespan. Well, break it down a little bit more. Fabricated metals, oil field equipment, computers and electronics, that's a durable. Chemicals and plastics, non-durable. If you look at that, the light blue line is the rig count. The black line is durables manufacturing in Houston. They track pretty closely, don't they? We can continue to see activity in the oil and gas industry. We'll continue to see the durable side of manufacturing continue to do well. If you look at chemicals and plastics exports, that $60 billion expansion that we had in the Gulf Coast, that wasn't built to serve the domestic market, that was built to serve the international market, and look where our exports are going. So we expect to see growth in the manufacturing side of the industry, and manufacturing side of the economy next year. I'm going to talk about construction. This is Dodge data, contracts that have been issued. This is on a 12-month moving total, meaning the 12 months that ended in October. You've got that little bar floating up there because that was the peak of that $60 billion chemical boom. So it skews everything off. But if you look at 15, 16, 17, and 18, you look at that, we are $2.5 billion ahead of where we were this time last year. So we are doing very well with construction. We expect to see additional construction going on. About healthcare? I was wondering if you guys would recognize that photo. Last year was a rough year for healthcare. We had rounds of layoffs. Part of it was uncertainty over the Affordable Care Act. Part of it was, frankly, a little bit of mismanagement in some of the systems. Part of it was just not understanding what was going on in the marketplace. Part of it was with so many people losing employment, they lost their benefits packages. We had a couple hospitals shut down because of Hurricane Harvey. And last year, for the first time in Houston's history, healthcare actually lost jobs. But the economy in general is improving. The uncertainty over the Affordable Care Act seems to stabilize. With the Democrats in control of the House of Representatives, it's very unlikely that they're going to do away with the Affordable Care Act now. And so we expect to see growth because the fundamentals, as I said, you don't look at a data point, you look at the fundamentals which are underlying that sector. Every year we have 100,000 births in the region. Babies are born, they consume a lot of health care in the first 3 or 4 years. I mean, I've got a new grandbaby. Anybody want to see pictures? You have 60,000 newcomers a year. So when they move here, they're going to have to find a doctor. They're going to have to find a dentist. They're going to have to find a clinic. And 30,000 seniors. We have an additional 30,000 people over the age of 65. Every one of those is a consumer of healthcare. So the size of the market for healthcare continues to grow. There are some issues about how it has to be paid for, but the demand will be there. So we've already added over 9,000 healthcare jobs so far this year. So healthcare seems like it's back growing again. Administrative support and remediation. God, that's a clumsy name, isn't it? It includes all these sort of things. It includes temporary help. It includes janitorial services, that back office administration, security guards, call centers, waste collection. Basically, it's 9 core functions in a business, or it's temporary help. Another way to play it's outsourcing. And everyone is outsourcing and trying to stay focused on their core. And you can see what the trend for administrative services or for outsourcing has been in Houston. Don't see that stopping at all. If anything, what's amazing, outsourcing is going to be moving into areas that we're not even, that people didn't even think about a couple years ago. I mean, even NASA is outsourcing. So outsourcing will continue. Restaurants and retail, population gains. You know, the number is a little bit lower than it was for 17, because I remember I told you we had domestic net out-migration, domestic, but it's international in the babies, but we're still seeing population growth. Retail sales, adjusted for inflation, are off the bottom. We're starting to see retail sales growing again. And this is after you take out gasoline, because gasoline prices fluctuate. But if you want to look at retail sales, 9 gasoline purchases, we're back up. We're not quite where we were at the peak, but we're starting to see growth again in retail sales. So that should continue to support the growing population. The growing retail purchases will support growth in the retail sector. So what's the partnerships employment, what's our forecast for 19? No, so you've got 2 columns. You've got this one column, what sectors are going to be adding jobs. So the other column, what sectors are going to be losing jobs? Because there have been a couple of years I've told you guys, yeah, we're going to lose jobs in oil and gas, we're going to lose jobs in manufacturing. Well, I can very happily say we actually expect every sector to add jobs to some extent next year. Looking at all the fundamentals that affect every sector, we don't see anything which is going to cause negative growth. Negative growth, I'm speaking like an economist, aren't I? We're not going to see anything that's going to cause job losses next year. There's your number, there's your headline number, 71,000 jobs. So it's a lot better than where we were in 15 and 16, where we're actually losing jobs. In 17, and the numbers are kind of flaky there because we had Hurricane Harvey come in at the end, and that drove employment because we had all that recovery effort. And 71,000 is actually a bit above trend. If you want to know what Houston should be doing in a normal year when the economy isn't being juiced by high oil prices or drugged down by low oil prices, we should be doing about 60 to 65. So this is actually a little bit better than long-term trend. And you're going to see it. These are the main sectors that are going to be driving it. Yeah, I know this is a little bit small. When you get your forecast, as you go out the door, you're going to be given one of these. This is explained in detail there, and you can look at this in more detail. But it's the sectors you'd expect to see growing: healthcare, construction, administrative support, that outsourcing, professional services, that's the white-collar jobs, the accounting, the law, the computer tech design, manufacturing, restaurants, and retail. Even these other sectors, even, hotels and information, are going to be adding at least some jobs next year. We really don't see any sector that's going to be losing jobs. So we get back to the order of the day. Keep calm and carry on. I want to extend this metaphor a little bit. Anybody watch the Texans on Sunday? Anybody not watch the Texans on Sunday? This has also been kind of the way we should have embraced the Texans the last 2 to 3 years. Because we went through 8 quarterbacks. Think about that. If you were a CEO of a corporation, or if you own stock in a corporation, and the stock in the corporation had 8 different CEOs over 3 years, I'd probably sell that stock. But, if we embrace that message, keep calm and carry on. But, it didn't get any better at the very beginning of the season. I mean, these are the headlines. You've got Bryant Smith, the Chronicle columnist. The Texans are soon already on the brink at 0-3. Jerome Solomon, season is over. and then the memes mock the Texans' pains after an 0-3 start. But we found a quarterback, someone who seems to have good footing, and look at where we are, 9-3. Well, I'm up here to talk about the economy, so I'm going to extend this metaphor. That's probably, what we should have said about Houston over the last few years, keep calm and carry on, because the headlines were equally dismal if you think about it 2 years ago. Houston area suffers more job losses. Houston's job prospects in the slow years, in the slow lane. Years of pain still ahead. Ooh. But, look where we are versus 2 years ago. Just look at where we are versus 2 years ago. Oil prices are off the bottom. The rig count is off the bottom. U.S. GDP is growing again. Foreign trade is looking good, even in spite of what's going on. We found a way to grow our foreign trade. Manufacturing, construction, retail sales. And these are the headlines of the last month. Big difference from 2 years ago. Slow growth ahead for Houston economy. Solid growth ahead. Houston employment rate ties a 10-year low. Data study ranks Houston among the best cities to find a job. Bottom line, if there's one thing that you take away from, if you don't take away the 71,000 number or the silly transition slides, Houston will experience solid growth in 19. I'm confident in that. 19 will be a good year for us. We're in a competition here. Sometimes it's a sports competition. Sometimes it's a competition for jobs. And you kind of look at that, and that's kind of where Houston is right now in competition for jobs. If you look at the jobs year to date, we're not quite top of the pack. I hate to see that Dallas is ahead of us. But maybe we'll see them in February or January. But you can look at it. We're doing pretty well now. Yes, I know the data will potentially be revised. Data's always revised, just like there are 4 games left in the season. So things can change, but if you think about Houston's sports team, if you think about Houston's economy team, both of them are in much better shape than they were over the last 3 years. And they have nothing but solid potential going forward. So with that, thank you very much, everybody. So at this point, I want to introduce Ellen Zentner, good friend. I got to know her through NABE. She formerly worked in the Texas Comptroller's office. So I have a formal bio I'm going to read, which is a little different than when I like to stand up here and talk. So it says here, I'm supposed to say, now that we have the Houston perspective, it's time to take a look at the national and global economy. To lead that part of the conversation, it's my pleasure to introduce Ellen Zentner, a Manager Director, Chief Economist for Morgan Stanley Research. Ellen has been named to the Bloomberg Best list of top forecasters of the U.S. economy and has 20-plus years experience as a Fed watcher and market-based economist with a keen eye towards early identification of market-moving trends. She and her team received the Lawrence R. Klein Award for the most accurate economic forecast each year in 2014, 2015, 2016, and 2017. Ellen joined Morgan Stanley in 2017 from Nomura Securities. She's also served as the senior economist at the Bank of Tokyo Mitsubishi and a senior economist at the Texas State Comptroller's Office. We were talking about Texas economy and Texas data, and she did not work with Bob Bullock, but she worked afterwards. Was that? Okay. She's on the Economic Advisory Panel of the New York Federal Reserve. She's a director of the National Association for Business Economics. She's also with the NABE Foundation and the past president of the New York Association for Business Economics. At this point, I'd like to ask Ellen to come up and share her insights on the economy. Thank you, Ellen. Thank you very much.
All right. I don't know, I can follow up after that entertaining presentation, and it was fantastic because that right there is a treat. It's not a typical presentation by an economist, which usually leaves people nodding off. It gives you a little indigestion if it's a lunch presentation. I'm not saying I won't give you indigestion, but it's nice because you're gonna take away a lot from Patrick's presentation because he tells a story. Unfortunately, I'm going to show you a lot of charts, but what I'm going to do is tell you a story around them so that's about all you need to have a takeaway as well. A little bit more on my bio before we get started. I was born in Montgomery County Hospital in Conroe, Texas. So I grew up not far from here. I actually grew up in Shepherd, Texas. Ever heard of it? If you haven't, that's okay. If you blink on Highway 59, you've passed it. And my father was the first mayor of Shepherd, Texas. I think the population today is still the same as it was when I lived there in the 70s. And then we moved to Austin, which is my mom's hometown when I was 8. So I really feel like I grew up in Austin, and my family is still there. So 8th generation Texan, I'm a daughter of the Republic and very, very proud of that. So I trained the Texas accent out of me I started at University of Texas, okay? I was a Longhorn, okay? But then I bucked the family trend and went to University of Colorado. See, you just crook the horns down a little bit because you become a buffalo. And my time there, I did my undergrad and graduate there, and I trained the Texas accent out of me and worked with a speaking coach for many years after. Because if I went from the Texas State Comptroller up to Wall Street, I was going to get killed if I had a Texas accent. It is unbelievable, the bias. And when I made it to the top, clawing and scratching and climbing the corporate ladder, and finally became chief economist of one of the largest financial firms in the global economy, I let it all come out again. I let it all come out in a big way. I don't need to fake it anymore. And in fact, I think what they call my folksy charm, which is really just being a Texan, now I think what they call my folksy charm actually sets me apart. And I think they've come to really like it. That's my personal opinion. Maybe I'm right, maybe I'm wrong. But anyhow, so let's talk about the U.S. outlook. It is slowing in 2019, so I'll give away the bottom line first. But like Patrick, I don't see a recession on the horizon. But I think it's very important that we embrace why the economy will be slowing ahead and see what the takeaways are from that. But first, let's talk about some of the key debates that we've been having, at least on the little tiny island where I live in Manhattan now, where everyone thinks the world spins around this little tiny island. But one of the key debates, how much tax stimulus did we actually get? How much did it stimulate the economy? And I would argue that we didn't get as much stimulus or stimulative effects from the tax cuts as people might have hoped, and for several reasons. On the left-hand side of this slide, I show you M&A deals in the U.S., mergers and acquisitions. Now, when we polled companies back in February, all of our equity analysts that cover all these companies, we said, what are your companies going to do with the tax benefits? And the number one answer was M&A. The number two answer was share buybacks and dividends. And our banking analyst has said all of that money that's been repatriated back to the U.S. has gone toward dividends. The third was CapEx, that's capital expenditures. That's great. That's more investment. The fourth one was labor compensation. And the fifth one was pay down debt. But essentially, companies are doing exactly what they told us they would do with the tax benefits. Unfortunately, that doesn't stimulate the economy in the way it would if, say, they had answered, number one, they were going to invest more. Now, why wasn't that the number one answer? We were already in an upswing in the CapEx cycle in the U.S., a very nice upswing in the CapEx cycle in the U.S. Labor costs had risen in the U.S. enough finally to start to incentivize businesses back toward adding to their bottom line, putting investment in place, expanding their capacity, paying their workers more. And so this is one of the reasons why, if you paid attention to the national news then, there were a lot of economists that were not too happy with the idea of putting in tax stimulus late in an economic expansion. We love lower taxes. That's great. And in the end, we'll end up with a better business operating environment overall that's more competitive for the U.S. But it was just a little ill-timed in terms of, normally you would put stimulus in place when the economy's down and out, right? When we're in recession and we need to bootstrap the economy back to positive growth, that's when you really want to hit it with all kinds of stimulus. Instead, you're giving money to businesses at a time when they're already investing, they're not cash strapped, There was no liquidity constraints keeping them from investing. Normally, that's when you put in stimulus. On the households, on the right-hand slide, the savings rate increased and has remained elevated after the tax stimulus. Absolutely, we've spent some of those dollars. I mean, I noticed the higher take-home pay that I started getting in my paycheck starting in February when all the companies that we work for adjusted to the new tax rates. Now for me, I've now climbed the ladder enough that I've joined the upper income groups. It didn't change my spending habits, right? It's just more money that goes into savings. But certainly that mattered for a lot of Americans. So we've seen higher savings and higher spending this year. But that just goes to show you that we don't spend 100% of the tax cuts. And so it's one reason why, which befuddles me, why some folks in Congress are saying, oh my God, we put in all this stimulation to the economy and revenues are dropping. Yes, revenues drop. Tax cuts do not pay for themselves. That was something that when I worked for the state of Texas, we always tried to convince the legislature and they never quite got it. But this is just our view of where all of the stimulus, where some of the stimulus at least went. Still, we're tracking 3% growth for the US economy this year. That is great GDP growth. So another debate, will trade harm the economy? Well, Patrick showed a lot of great headlines about what's going on with US and China, what's come out of the G20 meetings. Will they or won't they eventually put in the 25% tariffs? At the end of the day, they've put in 10% tariffs. That's a permanent. Right? This is not about rolling back tariffs that have already been put in place. This is about, is it a permanent delay in raising from 10% to 25% on Chinese goods that we import or not? So what is that 200 billion hit in terms of the Chinese tariffs that we're bringing, Chinese imports that we're bringing to the economy? Well, more than 30% of it hits consumer goods. That's really where you start to impact the US economy. But even there, we estimate that it's worth about 1/10 on GDP next year. You're going to get some price effects. Companies have already said that they're going to take advantage of passing on the cost of tariffs to the final good. So we're going to see some higher prices in the US economy when we go out to shop for things. And then it's up to individual households if they're going to tolerate those price increases and buy just as much, or if they're going to pull back on spending because of the price increases. So companies may either, it may just be a trade-off for some companies, right? Do they eat it on the margin, or do they eat the cost of the tariffs in terms of lower demand for their product? But this is the time that they should try to pass on price increases. We've just gotten nice tax cuts. We've got more money in our pocket. We're creating a lot of jobs. And companies have not been able to pass on the cost for a long time, even though costs have been rising. So if you're going to take advantage of it, now's the time to do it. But overall, when we've done estimates of how much trade will harm the economy, it's about 1/10 on GDP. And so whether the message out of G20 meeting sticks or not, whether we go to the 25% tariffs or not, that's a small part of what I'm going to describe as slowing the economy in 2019. So whatever happens with trade, I don't see it as a game changer for the US economy. Key debate number 3, is the yield curve signaling recession? Well, what is the yield curve? The yield curve is when interest rates on long-term US Treasuries, like the 10-year, fall below interest rates on short-term Treasuries, like the 2-year, say. And so I show the spread between the 10-year and 2-year interest rate on Treasuries. It's a great leading indicator of the economy itself. What is it telling us, right? When that inverts, it means investors are saying, I don't buy the viability of the outlook. I think a downturn is coming. And talk about self-fulfilling prophecy, Patrick. I don't think the financial markets are any better at forecasting the economy than economists. There, I'll insult us a little bit. Actually, economists aren't the worst. I'm not going to provide an oil forecast today because I'm in Houston. I'm not going to give you our oil forecast because I think you all know much better than we do on where oil might go. But I would say commodity strategists and weathermen are a little bit worse than economists. So we're not the worst, okay? We're not the worst. But investors pay attention to this. The Fed pays attention to this because it has been a good leading indicator of the economy. So when I'm in meetings down at the Federal Reserve Board in DC, there's a certain way that they always ask a question about the inverted yield curve. So it'll give you some insights into how the Fed thinks about this. They always ask, what would an inverted yield curve do to banking profitability? Because if it damages banking profitability, banks will pull back on lending. Commercial and industrial loans, commercial real estate loans, household lending, and that pulls the rug out, the credit rug out from under the economy. So they look at it more as a causal factor. Does an inverted yield curve itself stop the credit cycle? It's not inverted yet. It's been flattening all year. It's starting to get some policymakers worried. At our table, we talked about Kaplan of the Dallas Fed, is one of the most prominent voices that said, I will not vote for a rate hike that inverts the yield curve. He understands that it can impact business and ultimately impact the economy. But that's how the Fed's looking at it, and so it's something that we do need to follow. And another key debate, how long will this expansion last? It's now the second longest on record. If we make it to June of next year, which we absolutely will, it will be the longest expansion on record. You know, for Houston, I think Houston is so interesting. Sitting up there in New York, again, on that tiny little island where we think the world revolves around it, you know, we observed that the U.S. economy had a recession already. It had an industrial recession, and it was led by energy, by the downturn in energy. So in a sense, Houston already had its recession. So you've got a nice long cycle ahead of you. For the U.S. overall, I start the clock on expansion in 2014. See, the official start to the expansion was deemed to be June of 2009, basically when we started creating jobs, right? It's always tied to when you're creating jobs or when you start losing jobs, when they date business cycle expansions and recessions. So what happened in June of 2009? Well, the stock market had turned. It always leads us. The stock market had turned, and the economy started creating jobs in February of 2010. But in mid-2009, the NBER, that is the official arbiter of dating recessions, expansions, said, that's it, we're in expansion. But it was the industrial side of the economy, of the national economy, right? It was this energy miracle that was helping pull the economy out of recession. Households continued to delever, and households were deleveraging all the way through 2014. I used to go out and do public speaking at different events around the country, and even through 2010, 2011, invariably someone would raise their hand and say, what the hell expansion are you talking about? I don't feel expansion. And it took all the way till 2014 for consumer confidence to even rise to a level that has been normal for past expansions. And typically, when we have been deemed to move into expansion in the U.S. economy, it has coincided with deleveraging being over in the household sector, because typically the deleveraging period has been very, very short. This was talk about a bathtub. It was a very long, wide bottom for household deleveraging, but what finally ended in 2014, and that's when I would start the clock on this cycle. So I don't think 10 years worries me, that, oh my God, it's 10 years on, surely we're gonna have a downturn any day now. Cycles die of old age. They die of overheating, they don't die of old age. And so that's something to keep in mind. So where are we overheating? Not in housing. Economists always say, so goes housing, so goes the business expansion. Now, housing is always a regional story, so you can definitely point to pockets of overheating, but nationally, home prices are only just now about 2% above the previous peak. And in Q1 of last year, we finally passed the previous peak in housing equity. That doesn't sound like a household sector that is overheating. We've gotten some slower housing data recently. That's led some folks to be concerned of, oh my God, is a coming collapse near. And it's not. This is not a supply overhang where nationally home builders are overbuilding and there's just not the demand to support it. We actually have a perfect storm for housing right now, if you will, where mortgage rates have picked up by more than a full percentage point. So that hampers affordability on top of price growth that's been pretty robust across the country. And then supply constraints. Home builders are finding it difficult to build cheap enough homes. We put lumber tariffs on earlier this year. Their costs have gone up quite a bit. Their labor costs have gone up quite a bit. There's a shortage of labor. I don't know how many millennials are banging down the door to be construction workers. I don't know how many millennials are banging on the door to become long-haul truckers. Those are areas of the country where we've got a serious shortage of labor. But anyhow, so I spend too much time on housing. But that's one of the biggest factors you would look for overheating that would tell you the cycle end is near. Why is it overheating that ends in expansion? It's the Fed's response to that. Interest rates. The economy's overheating, the Fed's got to speed up and raise interest rates more rapidly, and then that's when we tip into a downturn. All right, so one near-term catalyst, and then I'll go through a couple of charts on the areas that we think are slowing in the economy. We're going to have a record high tax refund season coming up in the first quarter. Now, there are some groups of around the country that are going to be under-withheld on taxes. Don't play any violins for them. It's the upper income groups that live in the blue states on the sides of the country. I'm part of that group now, unfortunately. And anyhow, so we all used to get a state and local tax deduction for mortgage interest. And so that, of course, it's that perverse deduction that we have that encourages people to buy bigger and bigger homes to get a bigger and bigger deduction. We lost that deduction in those states. And so there are also some other changes in upper income exemptions that means those groups, those upper income groups in those particular parts of the country are going to be under withheld this year. But from the majority of Americans, we're significantly over withheld this year. So 75% of Americans every year, of workers every year, over withheld. It's a typical cycle in the US. We love giving the government an interest-free loan. We can't wait for what seems like free money to come back to us in the first quarter. It's like manna from heaven. We don't treat it as money that was owed to us. And we plan spending around it. We plan family trips around it. Back in my days when I still worked at the comptroller, right? My girlfriends and I couldn't wait to go to Mexico as soon as the tax refund checks came in, as long as it wasn't during an odd year, which was a legislative session, and we were barred from traveling from January to May. But anyhow, so it's a wonderful cycle in the U.S. that's fun. We all anticipate those tax refund checks. The record high tax refund season that we've got coming up, though, has nothing to do with whether your employer paid you what they were supposed to pay you. By law, every employer had to adjust withholding to the new IRS withholding schedules, and you saw that start to show up in your paychecks in February. It took smaller businesses a little bit longer. Maybe they didn't use automatic payroll processors. They had until mid-March, and then they had to back pay it. This has to do with you as an individual, because your tax situation may have changed. A lot of these large sweeping tax refund, tax cut legislations affect your actual tax situation. So what should you have done? You should have gone to the IRS. They have a special website. You put in all your information. It tells you what you should claim on your W-4. Then you go to your employer and you say, hey, give me a new W-4. You fill out a new W-4, you resubmit it, and then they further adjust your withholding. So how many of you went and did that? I'm surprised one person raised their hand. No, but seriously, past studies show that hardly anyone does that. And the Treasury actually sent out an email alert on this earlier this year and said, hey, Americans, get all the money that's owed to you. We just gave you these great tax cuts and you're not getting as much as you should. Go to the IRS website. They gave the website, so it told everybody what to do. The Treasury is not altruistic. Right? They don't want to be hit with a massive tax refund season in Q1 that creates a lot of uncertainty around lumpy refunds. But it's going to be, by our estimate, about 26% higher than normal. And so I'm finally getting to the point of this slide. On the left-hand side, it shows you when tax refunds normally hit. Notice it's pretty early. In most of January, the IRS has not opened the window for filing yet, but once they open the window, guess who files first? Those that know they're getting money, that they're typically owed a refund. Guess who files last? Those that owe. And so most of those refunds are going to come in February and March. So it's going to be great retail sales season then. You're going to see on the right-hand slide, we show what people normally do with that. Now, of course, we save a lot of it because you're going to send a payment to your credit card, get some of those balances down. That counts as savings. You could invest it. You could do anything. Anything that's not spending it on goods is counted as savings by the government. But look what we do. We take vacations. So maybe when you get back that much bigger than expected refund check, you say, honey, it's a 4-star Disney year instead of a 2-star Disney year. And you put that down payment on that family trip. You go out to eat. So restaurants tend to rake it in because what do we do when we're in a good mood? This is the same thing that we do when we go to fill up the gas tank and it costs half of what it did just some weeks before. Yeah, let's go out to eat. We love to eat when we feel good. And so restaurants tend to rake it in. Big durable goods purchases. We take that tax refund check and we go put a down payment on a car. And so either you make a bigger down payment or you get a nicer car. You put more features on it. You get that big screen TV instead of a 55-inch. Honey, I'm going for the 70. I think I had a 70-inch in my hotel room last night and I could not get far enough away from the screen in order to actually fit it all into my view there. But anyhow, I think this is a fun topic, so I've spent much longer on this slide than I'm supposed to, and I don't have but a few minutes left. Anyhow, so I think that's going to be great. And it means that we're going to have a big consumer spending number in the first quarter GDP. And so that's all. I'm going to show the shape of growth at the end here. That's also going to front load spending into the year because it does pull forward demand. So you're going to get some weaker spending in the back half of the year. It's not the consumer is deteriorating or household fundamentals are deteriorating. It's just that that's how it works, right? If you front load spending, you've got to have a payback. So the spending is going to be much stronger in the first half of the year than the second half. So here we go, and I'm going to run through this next set of slides quickly because it's just all it shows is that I know how to make charts. So now you're going to know I know how to make charts. So we've got a much slower growth forecast next year than consensus and the Fed. This is on a fourth quarter over fourth quarter basis, 1.7%. That compares to 3% this year. That's quite a big slowdown. So what's driving it? Because it's the story behind it that's so important. Well, you've heard everyone talk about fading fiscal stimulus. Some of that is just arithmetic. We don't drop tax rates every year. Oop, I thought I had an animated slide there, and I don't. All right, so we think fiscal policy impacts added about 0.8 to GDP this year, and that's going to fall to around 0.2 next year. So that's a reversal of 0.6. So that's a lot of that headline slowdown in GDP that you see. But again, some of it's just arithmetic, right? You absorb the tax cuts into your baseline in 2018, and we don't cut taxes again. And so you don't get that same amount of impulse in the next year. Also, financial conditions, the yellow line is basically the net of various factors that go into determining financial conditions in the U.S. What is the U.S. dollar doing? What are treasury yields doing? What are equities doing? And what's oil doing? Taken all together on net, we've had some tightening in financial conditions. So that's a tighter financial conditions backdrop going into next year compared with this year. So that will also weigh a little bit on growth. Uncertainty around trade policy and wider corporate credit spreads. Credit spreads have been widening. That does have a dampening effect on business investment. The left-hand slide just shows that I can make a scatter plot. And that scatter plot shows that corporate credit spreads do have an effect on depressing business investment. Funding for things becomes more difficult as corporate credit spreads widen. Now, right now, they're widening off of very tight levels. So overall funding levels look okay, but that's something to watch as if corporate credit spreads continue to widen. Some of the forward-looking indicators in the durable goods orders data point to slowing in business investment. No doubt a good deal of this is related to trade. Businesses are telling us that they're holding back on investment because of uncertainty around their trade environment, their supply chains, their pricing structures going forward. We'll see, how well we come out of this 90-day cooling off period while the US and China continue to negotiate. But businesses are still, at the end of the day, having to digest the 10% tariff that we've already put in place. And I don't know that there's a whole lot of trust in the administration right now that businesses are going to say, oh, okay, it's just delayed the start date. Either they're going to say it's just delayed the start date of the 25% tariff, or do they really want to make the leap and go ahead and make those investments and just assume that it's not going to happen? So I still think that there's enough uncertainty that is hanging on there. Also, global growth, as Patrick noted, is a little bit slower. That's going to affect demand for export orders and tariffs. We've got export orders next year growing at the same pace as imports. Exports in the US have to double the pace of imports to close the trade gap. So net trade is not going to add to GDP growth next year. Also, interest rate sensitive sectors are not going to contribute in the same way to the global economy as they have in the past. I mentioned mortgage rates have risen. There's mortgage rates shown on the left side, and that housing activity is slowing. That's on the right side. That's natural. The Fed's doing its job. The economy is growing so far beyond potential. The Fed's job is to slow the economy back toward potential. So you don't want it to grow at 3%, you want it to grow closer to 2%. The Fed's raising interest rates. That's going to slow credit. It's going to slow the economy. So they view this slowing in the housing market as just a natural function, a natural cyclical function of higher interest rates. But it also means it's not going to contribute to GDP. So what's bright in the outlook? Anything? I've talked a lot about, oh, you see, I thought I had another animation on there. Animations are fun. Instead, I'll just be animated up here. I've given you a lot of sort of negative factors that are going to be weighing on growth, but what's bright in the outlook? The household sector, which is great because it's 70% of our economy. So wages are growing. The labor market continues to tighten. When you look at wage growth broken down by segment and then by pay scale, we can see that actually wage growth is now starting to spill over. Wage pressures are spilling not just outward to capture more and more low-paying sectors. It's actually starting to march up the chain and capture middle-paying sectors and high-paying sectors, which is why you're starting to see stronger wage growth in the aggregate. We think wage growth is going to continue to climb from here and reach about 4% in 2020. Now, for companies, maybe they might say, oh, yeah, I don't want to deal with those kinds of labor costs. But that's why companies are investing more, because productivity drives profits. And if productivity is rising, then you can pay your existing workforce more, and your labor share of costs remains the same. So this is actually good news. On the right-hand side, the cost of carrying debt is extraordinarily low in the US, low interest rates. And so our debt service burden as a share of our disposable income remains at decades low. And here's something you might not have known. The outstanding household balance sheet, look at this mountain of debt. Looks pretty scary. You can see the period of deleveraging there I talked about that was over in 2014. But it looks pretty scary. But guess what's different about this balance sheet today compared with any prior time? It's all locked in at a low fixed rate. So in prior cycles, we're holding a lot of household debt. The Fed is raising interest rates rapidly to slow an overheating economy, and the interest expense incurred on that outstanding debt starts to eat into our disposable income pretty rapidly. So households have a knee-jerk reaction. They pull back on spending. Businesses see that drop in aggregate demand. They stop hiring. Guess what? 75% of this balance sheet is mortgages, and two very successful programs from the Obama administration, HARP and HAMP. Do you remember those? Home Affordable Refinance Program, Home Affordable Modification Program. We harped. I'm not ashamed to admit it. My husband and I harped. I wish we could harp again because we harped when mortgage rates are still on the way down. He gave me the side eye, like, shouldn't you as an economist know that mortgage rates were still going to fall? Again, weather forecasters. Only 10% of this balance sheet is subject to a variable rate. So last year, when the Fed raised interest rates 3 times, there is evidence that we actually made more money in interest on our savings than we incurred interest expense on the balance sheet. That's why households have been largely immune to the Fed rate hikes thus far. My time is up. One last thing I want to leave you with. So I'm an economist. I'm the dismal scientist, so I'm supposed to leave you on a sour note. So here's the sour note. It's the single biggest downside risk to the economic outlook. Okay, and that's corporate. I talked about corporate credit spreads and how they can, when they widen, they can depress investment. We follow that as economists because it also depresses job growth because it represents general funding for things like payrolls. All that M&A activity that we have done this year, debt funded because interest rates are low. But in order to get a BBB rating on all of that debt, most of those companies had to promise pretty aggressive deleveraging schedules, and many of them might not be able to meet it. And so if you leverage adjust that debt funded M&A, about 40% of it is actually high yield, not IG. And so it makes the US corporate debt vulnerable to downgrades. And so that's what we're watching. That's what our singular focus. It's something the Fed is very focused on too. We're watching corporate credit spreads. Again, they've widened, but off of very tight levels, and so that's fine. But watch those going forward. And I'll leave you on that note. Thank you.
Well, I am so pleased that we got Ellen back to Texas, and I could tell your Texas accent was returning even as you spoke. So please, as Ellen leaves today, give her a y'all come back, and then that'll just enter into her. Ellen, thanks so much. Let's recognize Ellen again. Let me just hit a couple of highlights on some events that are coming up. We have the State of the Airports, of the State of the Houston Airports on December 14th. Expecting a big crowd for that, a lot happening at the airport system. And looking out further to next year, the annual meeting of the partnership will be on January 31st at the Marriott Marquis, and we'll recognize Scott McClellan as the incoming chair of the partnership. So on your way out, don't forget to grab a copy of the 2019 Houston Employment Forecast, and don't forget the Business Expo that's going on outside for the next 30 minutes. With that, have a great afternoon. Thanks for being here.